everyone to today's webinar on an exciting topic. Can banks keep pace with payments? This is a question that really cuts to the heart of many things around banking, payments, and technology today. So I'm pleased that, first of all, to thank SmartStream Technologies for being our sponsor today. My name is Jame DiBiasio. I'm the editor of DigFin in Hong Kong. We have a really experienced lineup of people to talk about some of the big questions going on in banking and payments. This is a really, I think, a vital topic for today's times. So really, can banks keep pace with payments? The question itself, I think, is sort of indicative of where we're at today. You know, it's not long ago that banks were themselves the big innovators in payments technology, either banks or bank-owned consortia, which became the big payment processors of the world. And yet these days, it's the fintechs that are driving so much that's happening, and banks are finding themselves responding. Shirish, maybe you could walk us through a little bit of, you know, what is, I guess, the value add that banks bring today? You know, what still sets them apart? What makes them necessary? And how sustainable or stable do you see that value proposition?
So thank you for this, and thank you for the time on the call today. I think the question is quite at the heart of most of our questions that we keep asking ourselves. It's not about banking keeping pace with clients, but it's about banking keeping pace with the payments that actually execute. So coming back to the point you said, I think the biggest question to ask is, what actually does a payment mean to a bank? For a bank, the payment actually is a termination, as the end of a trade, end of a supply chain, end of a particular another use case that the bank actually supports. The payments on its own, yes, they exist. They are the payments that you make to your employees, the payments you make on government taxes. But the banks actually bring the other ecosystem for the corporate, for the client of the bank. So our relevance, or our ability to manage the entire supply chain financing section, that ends up in a payment. That's probably the place that we still are relevant. And not just that, and that's our call. That is the call that we have to now make. That how do I ensure that I keep facilitating supply chain? How do I keep facilitating extension of the central bank's monetary policy? That what banks do, expansion of credit. That's what we do. We just don't do payments. So for us, payments, yes, they're an important section. They generate enough revenue. I get paid because of that. But it is actually at the end of another financial transaction, another thing that we support the supply chain of the client itself.
But when so much of the innovation is changing, so users expect payments to be instant. You know, I should be able to go onto my mobile phone and bang, 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 and it's done. Are the pipes that you guys have built and operate over decades, are those pipes still able to keep up?
Frankly, no. And let's be honest about that. We have to acknowledge that we have been complacent for some time. For lack of strong competition, and that actually came through the democratization of the fact that computing power is now so cheap. In the past, banks were the largest, investors in technology. Today, technology that we do, or you need to stand up a bank is pretty cheap and very low barrier to create that kind of computing power availability. So that has created this particular change, that suddenly the rails that we have are not keeping in pace with what the expectations of commerce is, right? However, it's not a single answer of yes and no. It is the same banks who have invested their shareholding capital to create the fast rails that we have today. And the fast rails today are actually not just fast, and the word fast actually means very little, but the amount of intelligence that particular fast rail carries. It does pre-validation. It does, it can pay on demand. It can create aliases instead of making accounts. Account number, you can pay to an email, you can pay to a phone number. All of that also is the innovation that banks have led. It's our investments in those rails that are actually getting used democratically by every player in the market.
Those faster payment systems like we have here in Hong Kong and many other markets now, those are purely domestic, and I don't know to what extent. I mean, I use them as a consumer, again on my phone. I don't know to what extent a corporate treasurer is using them to the same extent. So I'd like to maybe bring Chintan into this. Chintan Shah from Deutsche Bank. Can you tell us a little bit about some of the ways where you see, I guess, different market segments and the differences in ways that banks are able to innovate and cater to those? So me doing something domestically as a consumer retail person versus a small merchant or a corporate treasurer of a large multinational people in global supply chains, like where are the differences falling out now in terms of where banks are leading and where banks are trying to keep up?
Hi, Jame. Thank you for having me on the panel today. Very relevant question. And the reason why I say that the entire payments disruption as we see are at different levels. I think the highest disruption that we are seeing is on the consumer experience in terms of enabling payments, whether it's P2P transfers, it's e-wallet transactions, etc. Right? That's kind of the extreme end of consumers having a very different experience on payments, and that's where I think the challenge for most legacy retail banks to compete with fintechs is where I would see the largest challenges. But as you extrapolate that to a corporate use case, corporates are keen to leverage that consumer experience and are keen to disrupt their business model by enabling collections through these channels for their enterprise, for their kind of e-commerce business. And that's where I think being able to plug into the payment ecosystem and this new disruptive payment channels is what corporate clients seek to do. Now, where can bank add value over here? I think two pieces. One is bank ability to integrate and tie up with these payment service providers and build partnerships and network and provide a comprehensive solution ultimately to the client, which provides this fintech or payment service provider linked solutions plus other cash management and FX liquidity solutions, makes it very comprehensive for corporates to kind of find banks relevant. Second, most corporates are not yet up to speed in terms of the entire emerging payments landscape and continue to look at their bank to help them understand what's happening in the industry and to help them identify partners and solutions that can work with them. They also trust banks more so than payment service providers because they don't have the kind of framework to assess what it takes to measure risk from a third-party service provider perspective when you're handling such payments. So again, there's an opportunity for banks to add value from a trust perspective to that. So that's kind of how I see corporates seeing banks relevant. There's one more element over here, and which is even for the payment service providers or fintech companies, where as they expand their business globally, they ultimately need banks to enable settlements for them. So being a bank to this ecosystem or being a bank to this payment service providers or fintechs, which ultimately offered such consumer experience, but providing them the rails, providing them the understanding of regulations, providing them solid anti-financial crime mitigating kind of solutions is where banks again would add value to this ecosystem in terms of being an enabler to those disruptive companies, which ultimately offer consumer experience that we all want to see. So that's how I see banks being most relevant at two different levels.
Thank you for that. Roland, you're a technologist. Give us a sense from what you see. You talk to banks, you talk to multiple banks around the region and the world on their payment controls and technologies. When you hear these gentlemen talking about the role of trust and connecting the ecosystem, those are of course valid and important. But in terms of just the core systems being able to keep pace, what do you see happening?
I think we have to face one reality, okay, and that is the world is going instant. The customer is going instant. Jamie, you said it quite nicely. You want your telephone to go bing, 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 and it goes. I don't see a reason why anyone in a corporate would think differently, okay? Because if you can do it with his own private bank account, why wouldn't he want to do that with his corporate account? So the challenge around that is that it's, first of all, has to be fast. Now, there are payment infrastructures that are beginning to accommodate that. There are plans also in the cross-border segment. SWIFT does that or is planning to do that. If you look Organizations like the Fed or in the UK, the Bank of England are beginning to follow the same concept as Europe in their cross-border payments. So I think there we will see a big difference. But the name of the game is instant. People want to see these things happening straight away. So I think that will require an adjustment. I also think if I look at, the history of digitalization, either we manage to do that in our financial networks or in banking, or fintechs will find another way. It's not impossible. Yeah, I remember distinctly 15 years ago when Kenya launched their M-Pesa system. There were Wall Street articles around the technology they used, and that works brilliantly. Yeah, it really does. So the technology's out there. So I think it's just a question of us adapting and understanding the foremost thing for any of us as an organization, be it myself as a technologist or be it a bank, is to satisfy the customer's needs and what he wants. So whilst I agree, there's a lot of factors around trust and obviously complex instruments, etc. Those are all benefits that we can use. But ultimately, it's just about one thing. I do the payment and it arrives on the other side and it arrives correctly, because the customer doesn't understand all the checks and balances we do in between. He only understands that when he sees it in the paper that we didn't do it, right?
So how do you advise or work with financial institutions if they've got, fintechs that are operating in these sort of closed loops? They're not regulated as banks. They don't carry customer deposits. Rather, they're able to efficiently move money cross-border very quickly, at least at a retail level, if not a large level. So what do you say to a bank that's got this, they've got regulatory constraints and requirements. Obviously, they're operating probably on legacy technology, but it's not just the tech, it's also just the business model. So, how are you working with people in the financial regulated industry to help them be able to make sure that they're keeping pace?
I think it's just, first of all, creating the awareness that time has become so much more important. And then the other thing is, there's a lot of re-engineering of their processes. So I think one of the things that we see a lot of work on is looking at taking the approach of a just-in-time value chain, right? So I think one of the problems that banks have are the multiple legacy systems, yes, which interact with each other, but they're not being built with the idea of having a straight-through production line. They've just been built with stopgaps, and then quite often you have these breaks in between those systems. Yeah, so it's taking a completely different philosophy around what we do. Ultimately, what banks and what financial institutions do is they deliver a virtual product. How you create that virtual product is actually not much different than how you would create a physical product. You're just using different instruments, robots, whatever. But you have to take that approach that you have a joined up process, that you are doing checks and balances as you are creating a transaction, so that when it finishes, it's correct. And that has to be fast, which requires a completely different technology stack to what we're used to.
Yeah. I want to bring Victor in. So Victor, your role these days is to help commercialize a lot of the innovations that Citi has been investing in. When you listen to both the sort of the broad use cases that your fellow bankers have outlined, as well as maybe some of Roland's opinions around the technology and his experience. What are you working on, and how much of it is trying to just make the legacy work better, and how much of it is really trying to pivot into something different?
Yeah, maybe for clarification, I'm essentially not a banker. I'm a startup tech geek who rolled up into a bank and managed to get a couple of things done. And so my perspective is essentially looking at green fields, new products and services, or supporting Citi essentially in navigating and providing value to either new value to existing clients or enabling new client segment access. So from that point of view, very little has to do with improving the legacy systems. In fact, like, we share some of the frustrations that a lot of the fintechs that try to interact with the traditional banking ecosystem share when we build our products and services or commercialize our partners. Where we see things moving and where my portfolio essentially is kind of more active is around 3 or 4 kind of big areas or big ticket items, mainly around first and foremost, and again, like, my perspective is wholesale. So where we look at enabling the value chain, we look at B2B essentially, and a couple of things. So as Chintan and Shirish mentioned, and Roland as well, the expectation set at the end user side actually moves to the B2B segment as well. When I have a certain way, a certain habit of operating, and then I do that as a consumer, I have the same expectation transferring to me as a business manager, right? And so we see that happening. And part of the reason why that becomes difficult in B2B is basically, 2 major trends. One is much of the innovation that banks invested in was essentially channel digitization, right? So how do we access the customer over all these new exciting channels? And that kind of creates an issue with the end-to-end pipeline, right? So essentially, you've built a digital channel, you access your customer digitally, but you have these stopgaps and these breakpoints, and you can't necessarily transition fully into an end-to-end digital processing. So this is one way of thinking, basically, of the end-to-end process and how that works. The second thing is that obviously we're seeing with some of the upcoming crypto and CBDC trends that there's a move towards, and I'm not going to talk about the asset here. I'm going to talk about payments as the asset that moves through the payment pipes is now smart. Essentially, it can embed instructions as a metadata, which means the expectations of what we're supposed to be able to do with it are much higher. So what comes from that? I need to be able to provide more detailed reports. I need to be able to bundle instructions. I need to be able to provide back-to-back payments. I need to be able to provide like more complex things than just moving essentially a dull asset from one point to another. And the third thing is essentially the I think what Roland and Chintan mentioned, the fact that there is a massive amount of personalization happening at the end. Different businesses have different contexts, be that because of the geographical imperative, be that because of technical, be that because of just the way that the logic of the business works. And so it's unlikely that the banks are going to be able to do the personalization at the end, kind of the micro targeting and micro personalization. So I think the shift of mental model from essentially like value chains to networks, from a pipeline into a platform provider for a lot of startups and fintechs to provide the customization at the end, is another kind of transformation driver where we're essentially investing and trying to build value in. And that happens all in the context of this kind of like big to small transition. Our head of innovation, Vanessa Colella, a few years back had put out a talk about how the fact is that we're moving from ROCs, which is bulk payments that happen on singular kind of events, into like infinitely small streaming transactions, right? And that is also something that's challenging the pipes from a purely processing KYC and AML point of view. So that's kind of the areas where we're spending quite a bit of.
Yeah. And just on that last point, Victor, so as we move to this, this constant streaming of small bits of data, how well prepared are the big banks, and maybe also you don't work there, but if you had a sense of some of the tier 2 banks in terms of being able to manage that transition? Are we going to be if we did this talk in 5 years from now, would we be talking to the same institutions, or would there be different players in the room who are able to do this?
Well, that's very difficult to answer, and I wouldn't, try to predict. But the fact is that there will be restructuring and recalibration of this. Like the way that you need to think about it is that, from moving, from moving things that are essentially thought of as physical in the mental model of a bank, all of a sudden, essentially, you're moving data, right? And in the end, we talk about simple data, metadata management, records on a ledger, and many of the banks are not necessarily handling that transition normally because they're not built like that. They're built as a risk management machine that moves more, or at least even if not physical really, but physical like goods and services. Even for example, things like the shift towards e-commerce and move to subscriptions and the whole digital economy surprised a lot of banks because risk has different shapes and forms in that world versus like when you're banking a physical store or a manufacturing plant. So how well that transition is handled, I think depends on answering two questions. One is, am I able to attract, retain, and motivate the right talent that's going to help me on that transition? And two is, how fast are my iteration cycles on being able to learn, like from experimenting in the market? If
right.
The answer of both of those is poor,
yeah, okay. Ben, Quinlan, I want to bring you into the discussion and just sort of jump on what Victor's been talking about. So in terms of those criteria to enable these institutions to keep up and remain successful, data and learning. You talk to a lot of banks. You advise some of them. How well are they doing? And just do you have a sense that that it's a natural evolution? Businesses are adapting as they should be, and this will be a fairly orderly evolution, or will we hit some crunches?
So, as an ex-banker myself, I'm very transparent around a lot of the problems that banks face when it comes to the payments ecosystem. And I think it's important to divide the conversation up in terms of the cross-border payments angle, as well as the domestic merchant corporate payments, which is where a lot of the technological innovation right now and disruption is happening. The cross-border side, banks have long dominated, but they've constantly faced three big overarching challenges. First one is around market fragmentation. The other is really around the IT infrastructure side. And then the third aspect is compliance. So on the first one, generally you have limited cross-border systems out there, huge amount of intermediaries and banks interfacing with multiple intermediaries in the form of correspondent banks to manage these cross-border payments. And then routing, which is largely not very transparent. So being able to track and monitor what is happening with data, there are systems and developments in place now to make that a bit better, but a lot of the fintechs are providing these overlays for the banks, and I generally find the banks underinvesting. Legacy systems, again, spot on with what was being mentioned before. The non-standardized processes and protocols, both within and across banks, is a major problem, as well as the data formats, lack of standardization of data formats. Again, it creates huge problems in being able to see through a whole payment and transaction cycle. And then when you overlay the big compliance issues at the end of it, particularly around AML, that's where the banks are running themselves into a bit more trouble. And I generally find that they're underinvesting heavily when it comes to automating that part of the process, because there's still so many backup people manually reviewing false positives and hits. There's a lack of automation there. And there's also a lack of real budget that's been allocated to this initiative for many banks, because it doesn't generate that direct ROI. It saves your ass from getting fined, but often I find it's quite unfortunate to see that underinvestment. And then even when you see like payment recalls, cancellations, rejections, it's not really a big problem for STP or currencies like US dollar, euro, British pound. But the non-STP part, which is probably 3 to 5% in our estimate of payments volumes, creates a lot of work for high volume processing banks. And there are some online tools that have been made available to corporates, less to retailers, to trace, track, and amend payments. But generally, if I speak to anyone in the industry, a lot of customers still prefer to call customer service, and a lot of these tools are often not integrated with a corporate ERP. So it generally requires a separate login. So the whole experience of this is not great. I have a lot more to say on the merchant side, just with respect to everyone else's time. Maybe we can pause on that and I'll share my perspectives later on that other part of where I see change and disruption occurring.
All right, great. Thanks, Ben. And we'll come back to that. We've got a question from the audience, so I'd like to give that some primacy. So I guess the question is, if you've got that comment you made about instead of moving large chunky batches, but rather a steady stream, I guess the question is, does this impact what's on the balance sheet? Does this impact the amounts that you're generating revenue off of? And I think maybe I'll start with Victor, but it also generates a question for, I see Shirish is shaking his head here. And I think I have an idea about what he might want to say about that. But Victor, I'll let you tackle that, and then we'll get Shirish's response.
So I think it's there's no simple answer here. I'll just give a small perspective on, I think it's a bit like the free coffee in certain restaurants, right? You may come from one thing, but you stay for it. You monetize somewhere else, right? You have something to bring the transactions through, but the business is made elsewhere. And I think that there's just a general shift around this. There has to be a general shift around this from a mental model and business model perspective. And this is where, as I mentioned, the question is, when you start thinking about yourself as a platform, maybe your monetization is not on the balances and on some bits on a transaction, right? It's different. And how do you add value-added services on top of that, so that you can actually have value pricing integrated? So yes, there's obviously a change, but what should that be? I think it depends really on the type of structure you've put together, the type of bank you are, and what are the other things you can cross-sell and upsell.
Shirish, I think you wanted to add your 2 cents to this.
So just absolutely 2 cents. I think to Victor's point, yes, I agree with what he said. I just want to make a slightly different perception on this conversation. If you look at the customer or a client or anybody, why would he choose a particular bank for making payments? The easier the bank is to take money out, that's where you keep your money in. So I actually think that if I make payments faster, easier, better, whatever version of discussion we've had now, smarter, the bank that does that more often, more consistently, and across multiple currencies is the bank that actually takes where you'll keep your money in. So I actually think faster money movement out also generates money in. So I actually think the question is good, but I think you invest more so that you can get more money, more people wanting to bank with you. Who would want to bank with a bank that does not connect to fast? So let's ask the question the other way around.
To Ben's point there as well, if you're not able to see if you're not able to see the movements and you're not able to see near real-time data on what's going on, if the question is about well, does this make a bank run at a high probability? Well, if you're unable to answer that question, doing faster payments but not being able to look at the data at the same kind of timestamp, probably puts you at certain risks.
Exactly.
Yes, of course.
And I think just my 2 cents on this is if you look at payments volumes around the world, they've exploded, but the size of payments have declined, right? The ticker size. So I don't see this as a problem. Banks traditionally approach this with a view to, as long as we do the onboarding, the background checks, and KYC is checked off, it's okay. Now, where they need to move to, and we coined this term in 2016, is KYT, which is at the individual transaction level, being able to implement the right technology to be able to monitor this, to spot all of the risks around, money laundering or suspicious activity, whatever it might be. That's the technological aspect, and you can't get away from this trend. It's just where things are moving. So I don't see this as something that banks should avoid. It just requires a different view and lens on the data that you are looking at with respect to the transactions, smaller but larger volumes, right? It's a different game.
Therein lies the challenge, right? The challenge for us to operate as open loop systems, right? I operate in a regulation in Singapore. Somebody else is operating a regulation in Hong Kong. I am trying to create in an open loop system a closed loop experience. And that's actually much tougher than it actually sounds, because you have to now make sure that even now, if I do a transaction, every bank in the chain will screen it once. KYT is great, it's a good idea. And I think many banks have a version of scoring the payment risk. And we have it, and sure, many banks have it. But the problem is each one of us doing it. And that is the real problem. The problem is not whether I should do it or not. And clearly, to Victor's point, if I don't look at the data in the payment, I'm lost anyway. So all of that I have to do, not just me, every bank has to do. And that is the challenge where we actually add cost to the value and not take it off. Today, the closed loop systems that run, they run on our platforms, honestly. Without a bank, they cannot get access to the fast rails. So we are connecting them to the fast rails. So what happens is, how do I operate in an open loop, naturally open loop system and run a closed loop experience? And that is the challenge. And that's where associations, consortiums, and standardizations, those conversations come into play, especially around non-value adding costs, which is, I would say it that way, but cost that is repeated by everybody, like compliance.
Agree. And then you throw in the problems with the fact that APAC, and it must be the hardest place to do the payments business, is so fragmented,
Africa.
Multiple ACHs, ISO 20022 adoption is not as streamlined and as clear as what's going to happen in the US and Europe. It's a nightmare. I think it's very hard for your role.
One thing this brings up though is whether it's talking about standards or talking about know your tech, I think a lot of what I hear from all of you in different ways is a much more open model of partnerships, plugging into other things. I think everyone in the industry now agrees, or at least they give lip service to the idea that the purely proprietary universal bank model doesn't really work anymore. Chintan, I'd love to get your thoughts on sort of, I guess, the way that you partner with fintechs in particular. And I know that I think Victor also sort of alluded to some of the struggles he's had as basically an in-house tech. And then I think, and Roland, I'd love to get your thoughts from the external side. So Chintan, let's hear from you in terms of partnering with fintechs or with other players. How it sounds great. It sounds all, yay, we're all going to collaborate now. How easy is that in real life?
It's not easy at all. Reason being, banks have very strong vendor risk management process when it comes to adopting any of this fintechs. I think the biggest challenge that we have is compliance risk and of course data, right? Data privacy laws. So when you look at any payment service providers or fintech companies that you want to integrate your product offering into, and the objective over here is as such. The banks have their own products and solutions that they've developed over the years, and that's like your bread and butter. Now, with the emergence of this new age solutions, there is always an opportunity to bolt on a use case on top of your tech stack, and then offer a client a comprehensive solution, which includes core cash management products or core payment products combined with one of these use cases that you will look to determine with this payment service provider or fintech. And that's where the real challenge comes in. Being able to understand, it's not just about KYC that you will do for adopting a client. This is far beyond that, because you're trusting this payment service provider or this fintech to manage your many clients' data and many other clients' payment volumes. So governance is extremely comprehensive. Like I said, it cuts across, and Shirish also made that valid point between open loop and closed loop. So idea is, while you want to create that kind of architecture to be able to do that in a model which is compliance across all markets that you want this product to be offered, or this bolt on to offer a service, then you need to also very carefully assess data onshore regulations that we have in multiple markets in APAC, where you need to keep the data onshore in that respective markets, be it Indonesia, China, or increasingly now India as well. Right. So those are the additional challenges. So while it sounds a great concept, and while there's a lot of effort going on this, the number of use cases will still be a bit fewer to begin with, till the banks find an operating model to integrate this entire fintechs into your ecosystem. That's what.
I just want to get a sense
now,
of.
I think the second challenge.
You outline the challenges, but also what are some of the success stories? Like, is it working? Are you seeing signs that tell you that it's tough, but this is the right way to go?
No, it absolutely works. Like I said, it just takes a bit longer than one would like to, because there's so much of so high expectations around being agile, and being able to bolt on an idea that you like. So you finally get there, but the journey is longer than one would expect, right? So ideally, in a real world, I would like use cases to be implemented, let's say, within 3 months on the outside. But it comfortably takes 9 months to get somebody on board and to commercialize it. So I think it's the time that needs to string, but the use cases are quite a few.
And Victor, just very quickly, you had sort of talked, you sort of as an aside that you made, it's very tough being sort of a fintech type person within the bank, that you feel the pain of working with the fintechs as well. Is it getting, what right now, what's the biggest stumbling block in terms of that kind of collaborative work with outside fintechs, or even sort of arm's length fintechs, even if they're sort of in-house?
So I mean, and this is very context specific, right? If you talk about something that's BAU and scale, then you're trying to integrate a fintech partner. You have one set of challenges. If you're trying to do something new, you have an absolutely different set of challenges. Like, for example, well, prioritization for things that are new generally is relatively low, given the fact that the book of work of running the business is so big. So that's kind of like one of the big things that we faced. And the second thing is that few banks, I think, have thought about creating safe spaces where you can essentially do a proof of concept, proof of value, test in a neutral environment, a sandbox of sorts, where you can then know that this is the way that things are going to work, and then put a roadmap. And maybe the third challenge is on the fintech side. I think a lot of fintechs look at a big institution and they say, like, okay, fantastic, like if I manage to get on board, and that I'm set for life, like my growth is secured. The problem with that is that they don't necessarily understand the journey that needs to take, and oftentimes the frustration ramps up. And so my general advice is basically being able to have interfaces such as labs, or such as, for example, what we are in D10X, where the use case is structured, the market is sized, it's understood where your integration points and where your internal partners are, and so you're essentially building a pipe, and then have a clear kind of separation of what's happening on each side of the pipe. That's what makes it easier in general. If you go and say, like, okay, let's now start structuring and co-creating the product together, you're in for a very long, painful ride.
Right. Okay. Makes sense. Roland, as an external vendor to many financial institutions, with this question of, I guess, open collaborative models, being able to partner and plug in, obviously they partner with you, but are you finding that these systems are becoming more flexible in how I guess you connect your clients to other types of platforms, or is it still fairly bilateral?
No, I think we are seeing generally people taking up and understanding that in order to achieve that, they potentially have to use new technology. That's always a challenge, not only on a cost side, but also in the case of adopting it. So, one of the things that came up was a streaming platform, which is definitely, from our perspective, a very valid way to move forward. And that will change things, because those are completely different stacks, which allow then suddenly completely different approaches. Things, like being able to integrate systems much better. So it's not just a question of, the tech stack makes it obviously a difference also onto what are your options, because it's just, they're different worlds. It's like comparing pre-mobile phone to smartphone, right? It's just, you can just do things a lot differently. Yeah. But I think what Victor said is very valid. It's about creating those environments where you can test things out, and also not only test, but validate what you're doing, because I think that's a big danger also with the tech world, with all the buzzwords like AI, machine learning, robotics, etc., etc. I mean, we've seen it with our innovation labs. We got so many suggestions where ultimately, when we looked at it, even put it into place, we had to say, but where's the value proposition behind that? Where is actually the benefit, apart from, it sounds great, but I'm using AI, right? So I think that's really important. And I think another thing which also goes back to what Shirish said, and also generally what Vineet questioned, And that is, I think we have to understand that this is a fundamental change in thinking that we now need to embrace. Up until now, in the banking industry, myself included, we always tend to look at products and review products or want to bring in new products when we see a revenue opportunity. Yeah, it's all driven by how much revenue can you generate. Yeah, that world is changing, right? The digital economy is all about how can you satisfy a customer's needs. And if you manage to do that, you will create revenue. But that needs a completely different mindset. And it's one of the reasons why we do have such a fragmented industry. We do not have enough standards, because all the time it's sort of like, well, how much money can I make out of it? Oh, I'm not going to make as much money as I would like. Let's not do it. Or as Ben said, it just costs, right? It's not a revenue opportunity if you want to really streamline your processes. But in actual fact, it's just more of a long-term revenue thing. And it's all about delivering to the client what he wants. And I mean, we've seen this in other industries. I just remember, you know, the music industry was caught completely off guard when you suddenly could download music. You know, before you could burn CD-ROMs, you could put it on a USB stick, all that stuff. That was annoying, but it didn't change anything. But now suddenly it was available and everything changed, because not because that's what the industry wanted, it's because what the consumer wanted.
Yeah.
The industry even tried to fight it with legislation at the time and say, you know, threaten the world, if you download music illegally, we will take you to court. Well, that's pretty difficult to do with 2.5 billion people, right? So, you know, that's the reality that we're facing.
One of the biggest changes potentially is money itself. So what is being paid, not in terms of for what, not whom is being paid, but what you're actually using. So the rise, the potential of central banks issuing their own digital currencies, which comes in different formats. Just curious to get a sense of what some of these panelists think about that impact or the potential way that could change what payments are all about. Shirish, you want to give that one a spin?
Okay. This is interesting. So what I see we are heading into, whether you call it stable coins, central bank digital currency, or regulated stable coins, rather, let's say regulated ones, you're heading into a very noisy period. You're going to be very difficult to separate noise and a signal. So multiple successes will come through and it will look like everything is working. One of the bigger problems with CBDCs is that in a sense today, banks like us who participate in the country's clearing systems actually use a form of a CBDC to settle between themselves. Now, what we're talking about CBDC typically when we say CBDCs is when it goes down to the retail person, and when you say people when customers are now customers of the central bank directly instead of customers of the commercial banks. This is the problem where we have to be very clear about what is the problem we're trying to solve, because it looks like a solution chasing a problem. If you look at the world in the developed side, you will still have people thinking again whether central bank digital currency beyond the programmatic value addition can create in interbank money movements, and absolutely that is an enhancement that should happen. But holding a currency in your hand as the Jane on the street, what is the value that you create in the economy, which is already fully electronic? You move that from there to people where they're trying to take away, the cost of printing notes is becoming redundant. That's another place we can go. Or you go to places like Africa, where we bank, we are present in 15 markets. We're talking about distribution of aid. Again, that's relevant. So we need to be really sure what use case we're solving, because all of them will look successful, but not all of them will generate value.
Okay. Chintan, is this something that you guys are looking at Deutsche?
No, I think Shirish captured it beautifully. I think it's got the exact right. When we look at the entire banking system, all of us have our money with the central bank for purpose of settlement, and the bank's money with central bank is nothing else but digital. Right? You could say it's a central bank digital currency because it's only central bank issued money that is in circulation and it's in the digital form. what we have done is then transmitted that value out to our clients in terms of the savings account that they hold with us. Now, if the objective is for central banks to offer a digital currency directly to retail individuals, it needs to be fit for purpose, nothing else. And that fit for purpose could be different by each country, by each corridor, achieving what it tries to achieve. I don't know so well, but the objective of CBDC in China is that to perhaps rein in a bit of the private e-wallet money in circulation, because that's been a theme in the last 1 year where the Chinese government have been particularly wary about the technology companies' expansion in those countries. So is this a direct kind of next 12 months focus on trying to move value out of the other e-wallet providers into a CBDC instrument and then provide consumers that e-wallet experience directly out of a central bank issued currency? Perhaps that could be an objective, but I don't know if that's still as good an objective or as large or as kind of structurally different a solution that would add value than where things are today. But the examples that Shirish gave on Africa in terms of making payments, improving financial inclusion, I think that makes sense.
It does sound like, though, all these fit for purpose use cases, some of them may fall by the wayside, but it sounds like the world of payments is going to get more complex and less standardized and not the other way around. I think we've got about 3 minutes left. Victor, questions around standardization and complexity. Are you pulling your hair out, or is this just another day at the office for you?
Yeah, it sounds like just another day. I think to the digital payments future. I mean, we already have like electronic money. The fusion is gonna take some time, but I don't remember the last time I was holding like cash in my hands. And I want to underscore something that Roland mentioned, which is ultimately it's the consumer needs driving. And I think that if we look at that, like we have the fusion obviously on electronic money. The question is, how do we get to a programmable money state, right? And that's gonna be like the next step. How? Like you have multiple answers competing right now. I take a bet on all of them. If you want to get successful outcomes.
Okay. One thing we didn't get really much time for is we didn't really get down to the merchant level, the point of sale machine versus the QR codes. I know, Ben, you've done a lot of work on this. We've only got about 2 minutes left, but if you want to maybe just give us a quick summation of what we need to think about.
Sure. Okay, so I think just on that merchant side, but first point I think blockchain will fundamentally disrupt the cross-border payments ecosystem, by the way. I think just picking up on that point, modernizing, running alongside legacy payment infrastructure, overlaying it with a much more rich information layer, and DLT will act as a very effective means of record keeping for audit. So I think from that perspective, regulatory requests, as well as the duplication point that was brought up by Shirish, a lot of these things can be resolved. So just on that, on the merchant payment front, 2 fundamental evolutions: channels from cash to card to contactless to digital QR code based payments. Functional, you're also seeing an evolution from mere payments to then sales, merchant integration, and then all the customer journey and experience. And when you look at the growth of e-commerce, everything going on, banks are understanding that the key opportunity for a lot of them is with these marketplaces, it's the checkout solution, aka the payment is crucial. That's going to differ based on the industry, the region, and so on. But I think a bank's value proposition comprises of overlaying different modules in there: payment gateways, risk tools, data management, reconciliation, reporting. I think that's all critical to making that ecosystem work. And that's where partnerships with fintechs are going to start to come in a lot more. The one thing that banks are also benefiting from, to go to Shirish's first point that he made when we opened this up, is payments is just one part of the ecosystem. What you're seeing is banks developing a broader ecosystem strategy with fintechs. Like if I'm a bank and I partner with Xero, and I can start to get two-way flow of information. From my credit perspective as a business, I can make much better lending decisions when I know real-time cash flows of the companies that I'm servicing. I don't have to ask for last year's financial records. So payments is a very important end result, but it's also an important enabler of upstream businesses in a bank as well.
Great. Thank you for that last minute summation. And it sounds like that's another webinar that we'll have to tackle that one on. Jens, we're out of time. I want to thank the audience. I really want to thank SmartStream for sponsoring this. Roland, I think you're going to be a very busy person over the next couple of years. It sounds like you and your clients have a lot of things to work on. Thank you for joining us. Ben, Quinlan, same. I guess your clients have lots of questions that your research can help them answer. And of course, to our bankers who joined us today, well, our quasi-banker, Victor Alexiev from D10X, and then two people in the formal seats, Chintan Shah from Deutsche Bank and Shirish Wadvikar from Standard Chartered. Thank you so much for joining us. It's been really super interesting. And thanks to the audience for the questions. And for DigFin, I'm Jame DiBiasio. See you next time.
Thanks, Jame. Thanks, everyone.
Thank you so much.
Thank you, guys.
Thank you.
Thank you.
Bye-bye.